All right, hello everyone. Welcome back to the Wide Lens podcast. This is episode number 6, and I've got Matt Rigby here with me. We're going to cover the hottest topics in financial markets this week. Again, just a quick reminder, YouTube to see all the charts and all the headlines, Spotify, Apple, Google Podcasts to listen in. And we've got a cracker this week, and we'll get Matt to kick off with Matt's Market Minute, which takes more than a minute. Over to you, Matt.
All right. So these numbers are for the last week, as always, week to date and year to date. So Aussie market, the ASX 300 up 2.5%, down 5.6 for the year. Quite surprisingly, markets have been pretty resilient since Russia invaded the Ukraine. UBS came out with some numbers that showed that during the reporting season, beats, so that is companies that exceeded expectations, were so beats versus misses, exceeding versus underperforming was 4-3. So companies are beating above expectations, which is good, and earnings have been upgraded by 2%, which is positive for the market. Notable advances, no surprising, the oil companies are doing well. Santos, Woodside doing really well. PointsBet on takeover speculation. And some of the smaller tech companies have gotten a bit of a boost, I think on the expectation that rates may not go up as early or as much. We'll see. The hazard of trying to predict it in the future. The Nasdaq flat this week, but since last Thursday when Russia invaded, up about 9.5%, down 13% year to date. It was up very strongly following the Russian invasion, which again, a bit of a surprise. Cybersecurity companies have done really well. Palo Alto Networks, CrowdStrike, Okta, although that was results driven. A couple other companies have done well. Mercado Libre, which a number of people may not have heard of. Big online Amazon-like player out of South America. Atlassian, the Aussie company, up 10%. On results. And Square, which was interesting, 1.9 of their near $4 billion in revenue was due to Bitcoin sales. So almost half of their revenue in the last quarter was due to Bitcoin sales.
What do you mean Bitcoin sales?
Well, because they accept Bitcoin as currency. So those transactions.
Right. Oh, they take a clip from that.
Take a little clip. Although the margins are quite low. Anyway, so quite good. Etsy also doing quite well. Year to date, the Nasdaq 155 stocks are down more than 10%. That was 73 last week, so slight improvement. Moderna for the year to date down 41%. Meta or Facebook down 38%. Moderna surprised me a little. S&P 500 flat for the week, up about 5.5% since Russia invaded. Down 8% year to date. Anti-ESG stocks has been the theme of the week. Oil, gas, resources.
What? What does that mean?
Well, they're not environmentally socially aware. So oil and gas, Freeport-McMoRan, which is a resources company. Defence companies have done well. Lockheed Martin, Raytheon, and gaming, Penn National, have done really well. The S&P 500, 26% in positive territory, 46% down more than 10%. And of the top 16 performers, 15 are resource companies, 13 oil and gas companies, plus Schlumberger, which is a services company to oil and gas. So a pretty strong theme there. Emerging markets, down about 6% for the year. Russia, down around 36%, which I think we'll touch on later. Although the market has been closed for 3 or 4 days, so that should be a hell of a lot worse. Oil up around 20% since Russia invaded, up around 45% year to date, now $110. I think that's the highest since about 2009, so quite a period there. And Bitcoin up 17% since Monday, down about 8% for the year. Up around 12% since Russia invaded, it's about $44,000 US.
Emerging markets might be up higher once Russia is removed from the emerging market
out of the
index. Just don't look at the frontier indexes. That might not be good.
Could be worse.
I want to talk about corrections. Sentiment Trader had this chart, which we'll bring up here now. And what it's showing is the number of days the S&P 500 has taken to fall from their 3-year high to fall greater than 10% into correction territory.
Right.
So the number of days it's taken to fall from its 3-year high, so not all-time highs, just the 3-year highs, to fall more than 10%. And this is as of last week. This particular correction took 33 days. And when we're sitting here in the market facing what is going on and with all the news and the headlines that are coming out right now, you think, wow, that was a quick decline, right? The market just got smashed. And forget the index, like stocks within it were getting smashed a long time ago, but now the index itself is falling, right?
Yep.
But if you look at this, going all the way back to 1929, it's more or less on par with the long-term average of how long it typically takes for the market to fall from its 3-year high greater than 10%. Sure, granted that it's skewed between some of the days that it took a lot longer. So you look at 1980, 1981, took 185 days. But it's also, we look at the very far right-hand side of that chart as well. During COVID, it took 6 days. In the blink of an eye, the market just collapsed.
In 2018, about 9 days, which is not much worse. And
Correct.
That's not to say the market doesn't keep falling. It's just how long it takes to get to a 10% decline.
Correct, that's right. And I think this correction ended the S&P 500's 11th longest streak of hanging within 10% of its high. So I thought that was really interesting to look at and to put into perspective. The next one I want to look at is from Bespoke, and what they are showing here is the NASDAQ Composite Index, so the 2,500 stocks in the NASDAQ, and it's showing the drawdowns from its previous highs. And so that red line is in bear market territory. So 20% plus is a bear market. I don't know who made that up, but that's what everyone runs with. And so the most recent decline you can see on the far right-hand side of that chart is putting the index down 21%. And that was from its record high back in November. So in a matter of 3 months or so, we're down 20% plus. Now this will be, if going all the way back to the index's history back to 1971, it'll be the 11th drawdown of 20% plus from a record high. And finally, I think probably what's more noteworthy is the fact that this recent drawdown represents the third 20+% drawdown from a record high in the last 3.5 years.
Yeah.
So investors have had a pretty wild ride. And if you're hanging in there now, I think now may not be the right time to take the seatbelt off and jump out the carriage. But it really just shows how brutal the market has been, the ups and downs over the course of the last few years.
Yeah, it's interesting. We've looked at data before that's shown that even last year was quite a stable year from a calendar year. But again, you widen the lens out a little bit and things are quite a bit different. Yeah,
that's right.
But that's just the price of entry.
Finally, just looking at market movements and all-time highs and all-time lows and so on, Sentiment Trader also had this chart which they call dumb money, whatever you want to call it. But what it's looking at is the amount of money or the amount of volume that's currently being spent on buying put options. And we've touched on this before, and I think we might just touch on what a put option is. So a put option essentially allows the investor, gives them the right but not the obligation to sell a particular stock. So if you've got a stock that you're bearish on, you can buy a put option on that stock, and it gives you the option to sell at a higher price if you think that stock's going to fall lower from that particular price.
Right, and you pay a premium for that.
Correct.
As well.
That's right. So it doesn't come for free.
No.
And so what this particular chart is showing is that we're seeing 29% of volume on buying put options was amongst the highest level in 22 years. And so when we again stretch that chart out to look back at what happened during periods of times where we saw retail investors coming in and reacting to what's happened, like taking insurance out on a house that's already burnt down, you had to have put your insurance in place before that, obviously. You can see the ratio in blue at the bottom, and you can see the S&P 500 on the top there. And look, I'm not saying this is perfect, but it's a pretty good guide to show when we have these situations and when you have retail investors coming in doing what they're doing right now, you start to see a bottom in the market.
Yeah.
And if you stretch out the time horizon long enough, markets recover pretty strongly from there on in.
Yeah, I mean, there's been plenty of research to show that the retail investor panicking is a really good indicator of potential bottoms. It's not perfect, like you said, but it's kind of close.
Look, the returns are pretty modest. I think longer term, like I said, the returns are very, very good, and I think it's because that the people behave in this way at precisely the worst time.
Yeah.
And so I don't know if it's, again, an indicator this time around, but certainly history has been a pretty good guide.
Yep, and we talked about last week about the short duration funds. Again, same sort of thing. The horse is bolted and people start to reposition after the fact.
I mean, I'm sure a lot of people have seen this, but Delbar, a research company, do a piece, I think they do it every year, that shows how the average investor performs relative to that of the market.
Yep.
And because of human bias and because of emotion, the stats show that the average investor performs significantly worse than the broader market.
Mm-hmm. Yeah, and it's happened for a very long period of time and consistently throughout history. History mightn't repeat, but human behaviour apparently does.
Let's move on to house prices.
Everyone's favourite topic.
Everyone's favourite topic and everyone's favourite speaker, Coolabah Capital. Yeah. I enjoy looking at Chris Joy's pieces. This was not a piece from Chris Joy, but certainly from Coolabah. I don't know who it was that published it on Livewire. The title was Fifth Largest Increase in House Prices in 160 Years will correct after rate hikes, which in and of itself I don't think is profound. But if you actually read the article, house prices had a stellar year in 2021. This is quote, with capital city prices up over 20% in the fourth quarter from a year earlier, in line with Coolabah's March 2020 projections. Coolabah never get it wrong.
They're brilliant.
Never get it wrong.
How are they still working? They should be well retired.
It never ceases to amaze me. Importantly, this means that the RBA will likely fully expect house prices to react, i.e. decline, as it starts to reverse the emergency rate cuts of 2020, particularly when the government has already wound back its fiscal support to households. When we replicate, actually before we do that, let's just bring up this chart. And what Coolabah have done, which is publicly available information, you can download the data. I think it's Stapleton's data. They've used Stapleton's data, ABS, and a whole bunch of other sources to go back to 1850. This chart is showing house prices over the long run. And you can see capital city house prices, calendar year observations of Q4 changes on a year ago. So 1 year change in house prices. Yep. The very first annotation, you can see Melbourne land boom is 21%. You can see a decline in the 1890s depression of close to 20%, 1930 depression. Interestingly, the 1930s depression was less than the 1890s. Yeah. And you think about 1930s depression, you think, 80% decline in stock markets. Yep. Property prices apparently only fell like 12%. After end of World War II, you've got 51% rise, and so on and so forth. So you can see that the latest one is 22% in 2021 calendar year, rise of 22%. I quote, when we replicate and refine the RBA's complex housing model developed by Peter Tulip and Trent Saunders, we find that it points to a 33% decline in prices after a permanent 100 basis point increase in mortgage rates, which I read that, I'm like, a model is a model, and a model is not real life. That's why it's called a model, first of all. Since October 2021, Coolabah has forecast a 15 to 25% correction in national house prices after the first 100 bips of RBA rate hikes. Most banks subsequently revised their forecast to shift to predicting price falls of between 10 to 15%. What do you think about this? Can I just put some colour on that first?
Yeah.
1890s depression, right? Where we don't have as much control as we do today. only fell 20%. Mm-hmm. I say only. But the other thing is, as time's gone on, those lower falls have been higher. So that not lower low, but a higher low, meaning the fall has been smaller.
Yeah. So you sure that's what you're saying?
That's what I'm saying. So what do you think about this?
Yeah, look, I saw this and was, I don't know, just a bit lost for thoughts almost. A 33% decline is a pretty, I mean, that's enormous. A 1/3 decline in house prices.
Can you imagine?
Now, we were chatting earlier and I was talking about construction costs and how I thought there was a correlation and you said, no, there's not. The correlation is more about population growth.
Yeah.
You think about what's about to happen, and that is migration is about to come back into Australia. Presumably, it'll take a little time to get back to where it was, but let's just assume in our model, which we've refined, let's assume that it gets back to where it was. It's hard to see. I mean, it's really hard to see that prices are going to fall anywhere near that. Like anywhere near that. 10%, sure. I mean, that wouldn't be surprising.
That's what happened in the GFC.
And
12%.
Yeah, it would be pretty normal.
Melbourne property prices, median price.
Yeah, I mean, I think the other thing to talk about here is the 100 point, so 1% increase in mortgage rates. So a 1% increase in mortgage rates would put variables at around 3.5%.
Sure.
And the 3-year fixed rate is now about 3.8. So I kind of mentioned that to point out that I don't think rates are going much higher than that. And
yeah, but what they're saying is if you put that 100 basis 1% in, the model says prices are going to fall 33%. And right, they're predicting 15 to 25.
But they're saying that's a permanent increase. So they're not adjusting for the fact that
it might go down again.
The economy's going to go to shit and interest rates are going to fall back down again.
Don't they say the central banks raise rates so they can cut rates? What does that mean, a permanent? Is that what they said?
Yeah, permanent. 33% decline after prices after a permanent.
What does that mean?
So I don't know.
Chris Joy, if you're listening, can you please elaborate on what permanent 100 basis points increase in mortgage rates mean?
And look, I think I can't remember. I think it mentioned in this article that, or another one I read that we'll talk about later on, that the ceiling for rate rises is a hell of a lot lower than it has ever been.
100%.
So I think, it might go at 1%, but I don't think it's going to stay at 2.5%, 3% for long. Honestly, I think if we get there with variable rates, if the economy can support that, great. But I don't know that it can. So I'm selling this. I'm not buying it. I'm not a buyer in 33.
Even if it was permanent at 1% higher than where we are now, or 100 points, I don't buy the 33%. Again, and I jokingly say a model is a model because it's not real life. And that's what makes it a model. But then to go on and forecast 15 to 25, I think that's being really pessimistic. I mean, if you're talking about historically what's happened, I can see why historically things have been as volatile as they have. But if that happens, I will put my house on the line that that central banks and governments will step in to stop the carnage. Can you imagine what will happen to bank stocks? Can you imagine what will happen to their profitability? Like, I just don't. That may be the case, but I don't think central banks and governments around the world will allow the consequences to unfold. If the last two or 3 years have been any indication of what's going to happen, I think central banks are playing a much bigger role in what's going on in financial markets.
Absolutely. I mean, just think about it from a self-preservation standpoint of a politician. No one's voting for you if house prices have fallen 30%. So of course they'll step in. Something would happen.
I don't buy. I thought it was really interesting, but let's continue on the property theme. You want to talk about something?
Yeah. So there's this article in the Financial Review earlier this week, late last week. I think it was late last week, talking about the number of new homes coming to auction. And I thought it was interesting just because we are always talking about, or we've spoken about a few times about the volume in the market, kind of what's happening in the market. Is there a lot of overhang of houses that haven't sold? And so I think this is out last week for the weekend just gone, that the highest level for a February weekend was 3,500 homes.
And it says
that
ever. Biggest February auction week ever recorded
in Australia, yeah. So I think it was the biggest in in Sydney. It wasn't the biggest in Melbourne, but it was pretty big. And for most other capital cities, I think it was the largest. And their theory is that people are rushing to sell before prices fall or interest rates rise. So my response would be, well, where are they living? If they're selling the home, are they renting? So surely they have to buy. So maybe they're downsizing. Maybe they're reducing their mortgage. I don't know if people are that.
But we talked about this last week. And I think we had precisely the same conversation where I think my response was, well, if I've got 3 homes and I sell one, I don't have to buy the second one.
No.
So it's completely plausible that people are doing this, but I don't think that's the majority.
No, I think you're right. And so I pulled out the Domain data for auctions over February. So the clearance rate, the pass-in rate was 13.4% nationally of all...
nationally.
Of all auctions. So if we're using this assumption that the largest number of properties have been on the market in February, of any February, then 13% clearance rate to me would seem pretty reasonable.
That's the withdrawn.
No, that's passed in. So so they break down the data: clearance, clearance rate, auction, scheduled, sold, passed in, sold prior, and withdrawn.
So the clearance rate sits at 70.5% for combined capital cities for February.
Yeah. And so there were some sold prior, some withdrawn, and the pass-in rate was...
You know how we were talking about this last week? I was talking to a real estate agent who said, in this particular area, I said, look, I think Melbourne's sitting at like 80% clearance rate. And he said, yeah, that might be true, but this particular area is sitting at 50% clearance rate. I'm like, 50% sounds really shit. Like, is that... And then I started probing him about, and I don't know how accurate this is. Again, if anyone knows, I'd love to hear more. That data is somewhat unreliable to the extent that if I don't want to relay the information to the central domain or whoever's collating the data, I don't have to. And if I've got shitty results, then I'm not going to showcase
as the
agent. Yeah, I could be totally wrong.
All right. Okay. Yeah. Well, then.
So what's the article saying?
Call into question all the numbers coming out of it. Yeah, so the article is just essentially saying, we're going to see, people are expecting to see house prices fall, so they're putting their houses on the market, and therefore more houses on the market.
Of course, if you put more supply on the market, it's going to reduce
lower prices. So I think this was Eliza Owen from CoreLogic. So this is a quote, our analysis suggests a correlation between the cash rate and the housing market is strongest at a 12-month lag. However, that lag could be reduced this time around by the fact that affordability pressures, that is borrowing, interest rates, living expenses,
inflation, etc.
Yep, and a rise in the average fixed rates may start to weigh on demand before a change in the cash rate. So essentially, what they're saying is interest rates move, and then there's a 12-month lag, and you see a strong correlation.
Yeah.
And then she goes on to say, because of the level of borrowing, which, as we've said, is really high, then it could be a shorter lag this time around.
Gotcha.
So it's reasonable to expect households would be more sensitive to the cost of debt. Yes.
Yeah, I mean that's not profound.
No.
Again,
I think we've mentioned it 20 times.
But I mean, the other thing is, like, my response is, so what? Like, so what if your property has gone from, and if we're using median numbers here, we grew 22% last year. Mm-hmm. Like, what's it going to fall? 2%?
5%? Even if it's 10, as we said earlier. I mean, it's.
But you know what? The headline will read, 50% decline from previous growth rate.
Yeah, that's it. Well, I guess it matters because of the wealth effect. So the wealth effect is this theory, and it plays out pretty strongly, is that if your assets are going up, your home, your shares, your used car, whatever it is, your coin collection, you feel wealthier, and if you feel wealthy, you're more likely to go out and spend. So if my house has gone up, I can see my share portfolio is doing really well, Super's doing well, I'm going to go and buy that car, whatever it happens to be.
And we've seen that. That's why we've got inflation where it is.
Absolutely seen that, and it's great for economic activity.
No, it's not, because now people are complaining the inflation's too high.
It's great for jobs. There you go. Are you happy with that?
We can't please everybody at the same time.
We can't please anyone at the moment. But no, so look, it doesn't matter in the real world, but in the battle of psychological headspace, whatever it is, to get people to continue to spend and not shut up shop and start saving, it matters to some degree. But, you only need your house to be worth a lot when you sell it.
Could it be at all possible, though, that prices don't fall, they don't rise, people aren't just getting what they thought they were going to get for it? So if I'm a vendor and I think my property is worth 1.5 million because of this anchor or some bias or recency bias, but the market's only willing to pay 1.4. I mean, maybe my expectations were well and truly higher than what the market's willing to pay. Because the market's going to pay what the market's going to pay.
Yep. And no house is the same. So just because your neighbour sold for 1.5 doesn't mean yours will. But the
price doesn't have to fall. It could just sell. It could just go sideways.
It was never worth 1.5. Is that what you're saying? It was always worth 1.4. I'm saying
it could go. It was always worth 1.4. You just thought in your head it was worth 1.5. And there's this wealth effect. I feel more wealthy because in my head I've made up this number.
And I've just gone and bought a $100,000 car.
It just goes to show how much of it is psychological.
Yeah. Look, so much of it is. And they talk about affordability, which there's RBA data up until September 21. That showed the ratio of housing debt to housing income reached a record high of 140.5%.
Yeah, you know what else is also a record? The level of interest that people have to pay.
Exactly. And I was going to say, I think we showed a chart a couple of weeks ago where, debt's gone up, but the monthly repayments are at all-time or near all-time lows.
Since 1980.
It's almost a meaningless stat. They need to look at loan repayments versus income.
Some people argue that it should be a debt to equity ratio as well. There's so many ways you can slice this thing, I reckon, but I don't think there's anything new there. What we're seeing is more supply coming onto the market, which is good for people. So people have now choice in and amongst a low supply environment. People can go through houses now, which is nice, and maybe just pumping some air out of this thing is not a bad thing.
Yeah.
You can't expect property prices to continue to grow at 21% every single year.
No, and they're not. And as we talked about, the rate of growth is going to fall. And even if we grow at zero for the next couple of years, things are still okay. And then this next chart, still related to housing, about the soaring cost of renovations. And I think if anyone is looking at a renovation, is undergoing a renovation, has been to Bunnings, you know that prices are going up, or might attend. So prices are going up, and at 22-year high, the cost of renovation. So this is an annual change in prices.
Wow, so it went from zero.
Phenomenal.
Is that during COVID?
So that's COVID, yeah. So that's COVID it must be COVID, because that's March 19.
Soaring costs. That chart looks insane. You look at the number, it's gone up 10%. Am I reading this right? Annual changes in prices in percent change, so 10%.
Which is interesting because timber has absolutely gone up by more than 10%. Yeah, so it's across the board, right? Yeah. It's everything. So I just thought it was interesting.
Is that a big deal, 10%?
Well, if you've budgeted, and it is if you the builder and you've got a locked-in fixed price contract, it's a big deal. And if you're the person that builder then builds for next, you're copping that.
So does this keep going up? Like, what happens with this? Or is this more of an inflation story?
It's absolutely an inflation story. It's an annual change. So at some point it'll come down because prices and supply issues will start to ease.
Or we're off a higher base.
Yeah, and we're off a much higher base. So we're off an extremely low base there of zero. And any time it's gotten down to that 1%, it's skyrocketed. I thought it was interesting because I've undergone a renovation lately, and I can tell you prices have absolutely gone up.
The ongoing saga.
Oh shit. Anyway, so what do you got?
I want to add to this. We talked about this in a few weeks ago where we mentioned I'd spoken to Scott Keck of Charter Keck Kramer, and he was of the view in a podcast that I did during 2020, I believe. It could have been later, where he was of the view that Australia is a pretty good place to be if you're migrating because of low density, because of a whole bunch of reasons that people will choose to come to Australia. Mm-hmm. Interestingly, Bloomberg had this article, which I'll bring up now the best and worst places to be as the Omicron threat fades. And they basically ranked cities all around the world. Countries all around the world. Interesting, I think, to a lot of people was Australia is sitting in number 5 position. And that's jumped from... Is there like a more stronger word for jumped? Like skyrocketed from position number 42 to position number 5.
Clearly human rights is not a factor in their calculation.
I don't know, but it moved to position number 5, according to Bloomberg, after it lifted a 2-year travel ban. And Omicron cases fell from a peak. So Omicron fell... borders open, and then so if you look at the chart, it ranked. There's a chart in the article. Maybe we can put this in the show notes. You can have a look. But if you highlight Australia and many other countries, you can see how it's ranked according to Bloomberg's resilience score.
Yep.
And then you see it do nothing, and then it just catapults. There you go, catapult from 42nd position.
Nice.
To
5th.
To 5th position.
Saudi Arabia, number 3. That was my human rights comment. And UAE, Ireland, that doesn't surprise me. A lot of cold countries, Finland, Norway, Ireland. I don't know. Anyway, they're really interesting, and I think that feeds into that migration thought conversation as well.
Yeah, that's right. That's what I was going to say. The whole concept of migration, Australia is a pretty good place to be, notwithstanding all the issues. And so going back to your comment about property prices, I just can't see how prices have this severe decline and that it lasts long. Like I said, during the GFC, we were down 12%.
And it turned out okay. And you know, if, as you said, population growth and house prices are correlated, which makes sense, then, you know, any level of migration coming back.
Although the other biggest contributor to prices is lending by banks. So if you run an overlay bank lending growth and house price growth, there's a pretty high correlation there.
Yep.
So it depends on how much money people are willing to lend, but also depends on how much our population is growing.
Yep.
Interesting about interest rates going up. I get all of that. The other thing I think we just need to be mindful of is wage increases. So if interest rates rise and we continue to see wage growth, then maybe the two net each other off. I don't know. I haven't done the numbers, but maybe those two net each other off.
Yep.
And we kind of just plateau for a little while rather than this ginormous collapse that everyone's predicting.
Yeah, and that we said similar things in equities. You know, if earnings grow and prices stay stable, then prices don't fall. You know, the PE ratios compress and everything's okay.
So let's talk about the elephant in the room, Russia.
Oh, bloody hell. All right, so it was a week ago today, almost to the hour, that they invaded. Man, there's a lot to unpack here.
Yeah, I don't know if we're going to cut. I don't know if we're going to get through it all, but let's start going through it.
Let's rip. So the first article here we'll bring up is Russian markets are becoming uninvestable as sanctions bite. Companies are pulling out left, right and centre. So the Russian stock market fell around, I think it was 35% on the first day. And then it's been closed for 3 or 4 days. The futures are indicating that's going to be a hell of a lot more. Maybe, 60% from the pre-invasion point, and $13 billion of sanctioned stocks held by US and European funds, which they can't get out of. And I think Russia passed a law to say that you can't, either foreign investors can't sell or they can't withdraw the money out of the country. I don't know which one it was, but they're panicking, basically.
So Apple, Google and Ford have halted sales to Russia. ExxonMobil pledged to cease new investments in Russia. The one I didn't know, Wall Street Journal published this, was Russian customers of sanctioned banks are cut off from paying for foreign goods and services, which is a pretty big one. Russia got cut off the SWIFT system.
Huge.
You know what I've learnt out of this is sanctions that were imposed, many, many years ago.
After Crimea.
Was it 2014?
Yeah, I think it was 7 years ago.
But I feel like those sanctions are very different to sanctions now, where it feels like a whole community, the global community, are like rallying against Russia. And look, I don't know what the two sides of the story are. To be to be blatantly honest, I don't even know why Russia's invading Ukraine. There's lots of rumours as to why, but I'm not exactly sure.
There's only one man that knows.
Well, that's true.
And he hasn't told anyone.
No, he did a press release.
Did he?
It got released yesterday to the Russian people.
Right.
But it's all
truthful.
It's all in subtitles.
Yeah. You couldn't read it,
but so I couldn't listen. So you have to watch it. So I don't understand Russian. Slight problem. But the point that I'm trying to get across is that I feel like the impact of sanctions now are really powerful.
Yeah.
Like excluding people out of the financial system now, I feel like it's a much bigger impact than it had 5 years ago, 10 years ago with countries around the world slapping sanctions on nationals and a whole bunch of people.
Yeah.
Things like being stripped out of MSCI and MSCI, stripping out of indexes.
That's crazy. I mean,
I never had even thought that could possibly be a thing.
Absolutely the same. Yeah, no, I agree. And I think what's really interesting is, to your point, is we're such a financially, globally integrated world that it's a pretty drastic step. Although I don't think I don't think all Russian banks have been removed from SWIFT. I think some, but there's a couple that's still not.
Yeah.
And I was listening to...
The ones operating from garages are all...
Yeah. I was listening. You posted or liked an article on LinkedIn, or a video on LinkedIn the other day. Ian Bremmer. Ian Bremmer, yeah. And he was saying that...
Oh, you listened to that?
Yeah, I did. Man,
it's
fantastic.
Yeah. So I reckon you don't listen to anyone, just watch that video.
Man, absolutely watch that video. It was really worth it. But he was saying that it was the US holding the Europeans back from a full exclusion on SWIFT, whereas in years gone by, it's been the US dragging Europe to the sanctions table.
Yeah, correct.
Which is really interesting. And I guess the other thing to note is, Switzerland are kind of jumping up and down going, we need to kick these guys. Germany have gotten off the fence. So this, I think this is going to do the complete opposite to what Putin was hoping to achieve. This has bloody galvanised Europe. It's increased their defence spending. It's made the US and Europe a lot closer. This, I hate to say it, but this could get a whole lot messier.
So Bloomberg is calling Russia's stock market, or Russia being uninvestable. What else? What other headlines have we got here? So let's just bring up this chart, market routes. Russia's 33% plunge is the fifth worst one-day drop in stock market history. I thought, when I heard the 33%, I thought, wow, that's a big drop. But then when I saw this chart, it's still what did it say, the fifth? I thought, oh, wow, yeah. I'm not sure how big the Kazakh stock market is.
Mongolia.
Or the Mongolian stock market. But there have been, that's the price you pay for investing in riskier assets, right? Is it not?
Absolutely.
Is that too easy
I think
way out?
It's easy in hindsight, right? I don't know that I don't think anyone foresaw these sorts of sanctions coming. Putin, I'm sure, didn't think that everyone would react so quickly and so severely.
Is Putin laughing about the fact that we had severe inflation, now our energy cost? How much is petrol? Like
$2. $2 a litre.
Is he just having a bit of a chuckle to himself? Going, look at this.
Yeah, the hard thing is, I don't think the sanctions really hit him.
Who was it hit?
Well, they hit all the people of Russia. All these companies.
Aren't the people?
Well, this is what I mean. It could get really
Isn't
messy.
Russia the people? Not as a communist regime, but you've got a small group of people that basically control
everything. Yeah, I think. Well, the oligarchs their wealth has been declining, but I think how do you impact Putin? Maybe it's through having people rise up and try and overthrow him.
Dude, we are way out of our league here.
Yeah, absolutely. But it's interesting to.
So talking about oligarchs and wipeouts. So Bloomberg had this article: Russia's ultra-rich count cost of $83 billion wealth wipeout. Global sanctions damage Russia's economy and financial markets. EU freezes assets, bans travel for the country's tycoons.
Mm-hmm. It's just continuation
just another
of the
lockdown,
theme, right? And, the Russian central bank increased interest rates to 20%. This chart will bring up here the Russian government bond yield sitting at 12.8. I don't know what date that chart's at, but it could well be higher.
No, that's latest date.
Oh, is it?
That's today. I put that chart up today.
That's the second highest in the last 18 years, thereabouts. So it's all turning to shit, really.
Just on that chart, actually, like everyone's talking about everything collapsing. The same thing happened during the global financial crisis. The same thing happened again in 2015.
For bond yields, right?
Bond yield, yeah. So we saw a massive sell-off.
But they had no sanctions at that point.
No, they didn't have sanctions. Has that chart just turned? Like, is it peaked?
Yeah, I don't know. Is that just the dot? Who knows?
I was going to suggest something, but I won't.
We'll check in next week.
Just one other thing I was going to... So Russia halting oil production and we're seeing prices rise. The US came out and said they're going to...
Are they halting oil production? Or they just can't get it out?
Maybe they can't get it out.
Some of the shipping companies come out and said, we're not going to Russian ports anymore. We're not
So
shipping.
The US came out and said they're going to release 60 million barrels of oil.
Yep.
Do you know how many barrels of oil Russia produces?
Per day?
Yeah, whatever.
I'm going to say more than 60 million?
Yeah, so...
I'm going to say million a day.
11 million barrels a day of crude.
Fuck. Seriously? Well, my thought was...
when the US we're bringing 60 million barrels. Like, isn't Russia just like...
I think that was the US and a bunch of other countries.
Yeah, correct.
Well.
Yeah,
so
that's right.
they're like, all right, that's 5 days.
it's actually
5 days of our production.
Yeah, correct.
My thought was, how many barrels of oil does the world consume every day? It's got to be huge. Is it 60 million? Like, is it just 1 day's worth of global usage? I don't know. But look, I also read that companies are not, banks are not facilitating payment for oil and gas between countries. And
Sorry,
buyers.
man. 88.5 million barrels per day.
Wow.
That was in 2020.
Okay.
So the 60
and that was
million
in lockdown, so surely it's higher.
So the 60 million barrels it's like that'll last you till lunchtime. Let's move on.
Move on. Look, the last thing I'll mention on Russia. No, it's not the last thing. Second last thing I'll mention. There's an Aussie fund company called Coda Capital who came out and basically they released a note to their investors. Last week, basically saying, load up on Russia, it's cheap. And I just...
you were pretty disappointed about that, weren't you?
I was shocked. Honestly, I was shocked. And I think
why is that an issue?
Well, there are two issues here. So their comment was, if I can find it, something like they spent an hour with a...
Russian fund manager.
Prosperity Capital Management. So a Russian fund manager... equity fund manager. They've spoken to a Russian equity fund manager, and it's surprising, but the Russian equity fund manager said, buy Russian equities. I mean, it's shocking, I know. So they spent an hour chatting with the Russian equity fund manager, and then they sent out a note to their client saying, load up, like back up the truck, buy Russian equities. And I think probably the most disappointing thing was just the dismissive tone that came across in what they had said for what was going on, the complete disregard for the human cost. And I think that's probably what got to me the most. But
so just on that then, how do you feel about defence stocks?
I knew you were going to ask this, man.
So defence stocks are skyrocketing. They're up 22%.
Lockheed Martin,
How is that any different to supporting a cause that shouldn't necessarily be supported?
I don't know. Is it the direct versus indirect?
Who cares?
Lots of people, I'm sure. So Boeing, Lockheed Martin, I mean, they all make planes, aerospace, not necessarily arms, but that is a big part of their business. Raytheon's another one. It's a good question. We've talked about this kind of how do you plant that moral flag? Like, where do you... I don't know.
And the issue is everyone's moral compass is very different.
Wrong.
Yeah, look.
For this to come out. Anyway, so, I just thought I'd mention that because I haven't seen anyone else come out saying buy Russian equities.
No.
So Coda, and I don't know if Coda have walked back from that. I haven't seen anything, but
Yeah.
I'd imagine they're probably copying a bit of heat.
Yeah, well, I'm not sure how good of a story buying Russian equities is anyway right now. With all of that that's going on, the thing that I found really interesting was Bitcoin volume spikes in Russia and Ukraine as sanctions hit. So there's a chart here which shows the daily volume of Bitcoin to ruble. So how much Bitcoin is being traded in Russian currency. And
Just hang on. What if the Russian currency falls by 40%? Does that increase the volume?
volume.
Yeah, okay. I was thinking value.
No, volume.
All right, sorry. Keep going.
And just look at this chart. And so, if you're being removed from SWIFT and you can't move money across,
What else have you got?
DeFi.
Is this kind of like a watershed moment for Bitcoin and crypto? Does this kind of make it a little bit more, I don't know, are we a big step closer to it being a legitimate transactional?
So I'll
Currency.
just bring this chart up as well. You can see it's a chart of Bitcoin in US dollars, and it jumped about 20% since Russia invaded Ukraine. And you can see that big jump here on the far right-hand side of that. And so what people are talking about is blocking IP addresses from those in Russia to not be able to trade in crypto.
I hadn't heard that, right.
I don't know how they do that, but then there's talk about potentially just blanketing Russia out in trading crypto.
Right.
And they go on to say crypto is meant to provide greater financial freedom for people across the globe. To unilaterally decide to ban people's access to their crypto would fly in the face of the reason why crypto exists.
This is the whole...
Bang.
Yeah, absolutely. It potentially undermines the whole...
Does it?
Decentralized finance. I mean, if you can go and block
100
people in a country,
100%.
then it's no different to everything else, right? It's no different to SWIFT. But I saw a video, actually Carlo was telling us, a video of a Russian reporter who was trying to get up north, couldn't get money out of his bank account, so he bought or hired a car using Bitcoin and then drove up north. And it was just an example of how, it's almost how adaptable humans are as well. I mean, we'll find any way to get to our goal. But just the ability to use crypto as currency is...
Let's quickly touch on director's cuts. We're running out of time.
Cool. All right. Do you want to take the first one?
No, you go for it.
So the ProBuild bankruptcy. So ProBuild, big construction company.
There hasn't been much about that.
It's been
I think
very quiet.
because of Russia, Ukraine,
Something
do
else
you
going
reckon?
on. Yeah. No, I do. And there's so many things here. But as this is director's cut, really quick. Which banks have exposure?
Yeah, I don't
know. I
haven't seen anything.
That'll be something to
Admittingly,
watch.
I haven't looked too much into it. So,
but also it's the early stages.
Yeah, that might be just a work in
ProBuild is
progress.
owned by a South African mother company. Effectively, they've cut ProBuild free because they're making losses, something to that effect, and didn't want to keep funding them. So yeah,
I think that's a space to watch. Whether that might be being overshadowed at the moment. Who knows? We'll see what happens.
Yep.
Next one, Volkswagen is looking to spin off its trophy product Porsche. And I think from what I understand is that they're looking to leverage the whole EV movement and creating a completely separate company. I'm not sure what the issue is with that, but I know a number of enthusiasts that are not very happy about the fact that classic Porsche brand is moving into EV.
electric.
With oil prices at $2 plus, who wouldn't want to go
Pretty compelling, right?
into electric now? So I found that really interesting with the Porsche IVO, and then Ford is splitting its car manufacturing business into a separate EV only, and then internal combustion division. When are they doing that by?
I think they've started, or very soon. They announced it just recently. But the other thing is that there's been a few rumours of late that Ford may spin off, similar to Porsche, one of those divisions. It's not clear which, for the same reason, to
What does
raise
spin off
capital.
mean?
To float it,
Right.
to maybe sell it as an outright to an IPO or a spin-off in specie share distribution to existing shareholders.
Why would they do that? Why wouldn't you just raise capital at why wouldn't Ford just issue a bond at ridiculous
Why
rate?
aren't Porsche?
I don't know.
Yeah, I don't know. I think they want to. I think they can see down the road that maybe the internal combustion business starts to weigh down and slowly dies, and it's the EV business. That's
Yeah,
gonna
but I
drive the
mean,
business
Amazon's online business is making a loss, and AWS is holding the thing up.
But will the internal combustion engine continue to be the money generator it is now? Maybe now's the time to spin them off, milk the other one for all it's worth, throw some cash into EV. I don't know. It's interesting. I don't know why they're not looking to borrow, but look, everyone's chasing Tesla. I think is probably the bottom line story here. Yeah, Tesla did it years ago. They've proven how successful it's been, and they've done pretty well. One thing I want to just quickly mention, and this is something you don't hear or read about all that often, the Ukraine issued 277 million of war bonds. So basically, these are bonds issued during war times to fund the war.
So why is it
Inherently
okay
risky.
to do that?
Right. Well, they're defending themselves, right?
Yeah, but everyone's claiming defence.
Well, it's hard to claim defence when you're invading, surely. Best defence is attack? I don't know. I don't know.
Maybe,
anyway,
yeah.
it's yielding 11%. And the most interesting thing about this was the number of retail...
Who was a lead manager on that?
I don't know.
Cleaning up.
The retail investors trying to get in to buy as their way of supporting the Ukraine government, which is fascinating. The other thing I thought is...
11% is pretty high.
Very
Rates
high.
are pretty low.
I mean, they're talking to guys in Italy going, well, what's the difference between an Italian bond and a Ukraine bond? I mean, I think
You can
it's
buy
fair
a
question.
Russian bond for 12%.
You can.
Let's move on. This is
Well, I was just
going
gonna say, maybe that's a really smart way of the Ukraine locking in other countries. If, let's say, the US government decides to buy some of these bonds.
How much are they
then
issuing?
they're-
277 million.
It's not a lot.
Big deal.
But they're going to issue more. They're going to have to. Anyway,
Let's move
the
on.
other thing, Bank of Canada, 25 basis point rise. Interesting. Rates are going up everywhere.
You reckon the Fed's raising rates in March?
25. I think they should go 50. I really do.
Is 25 too soft?
I think it's too soft. Anyway, what do I know? That's what
Well,
I'm sitting here.
I think, and stocks are going up, and I think it primarily because of what's going on in
Because they think
Ukraine.
the Fed won't.
Correct.
Or it's come back from 75.
It's gone from 150 to 175 to potentially now zero.
Yeah. Yeah.
So we'll see what happens over in March.
What, the 15th, I think it is. So a couple of
Weeks. Yep.
All right. Tips and recommendations. What do you got, Rob?
All right. So I've got two quick ones. I went and watched Sing 2 with the kids. The movies.
Yeah.
And it was, I don't know, I just find myself laughing out loud at kids' movies because you know how they make a lot of adult jokes?
Oh, they do.
So funny.
Very smart about it.
I also remember, I don't know when you were a kid, but what kids' movies were out? Like Disney used to make I
don't know.
romantic kids' movies.
Were they ever released in a cinema? I didn't
don't
have a
know.
cinema where I grew up, so
I can't remember. But I feel like kids' movies now are less so about type of movies that we grew up and it's more about the whole concept of, believe in yourself and you can do anything.
Resilience.
It's that. But they make them absolutely hilarious. If you want to go see that, even if you want to go see it, man, I found it hilarious. We ordered an ultra-sized popcorn too, and that finished pretty quickly. So ultra-size wasn't that big. I
What
reckon
did that cost you? $30?
No, it was like $10. We're a Hoyts member. I think there's shrinkflation. It wasn't that big. The other thing I listened to, Bloomberg have got a podcast called Odd Lots. And I listened to Howard Lindzen, who, I don't know if you know Howard, but Howard, he's an investor, he's an entrepreneur. He's built a whole bunch of businesses. And the interview with him, Howard Lindzen, on what's really going on in the tech plunge. Howard goes, and man, I'm still listening to it. I haven't finished it yet. But he goes right into what is going on, not only in public markets, but his domain is very much in private markets. So he talks about what he's doing. So he's got a SPAC, what his SPAC's doing, what investments he's funding, what he hasn't funded and why. And it's opened my mind up to a whole new area that I really didn't spend enough time in and in fact know that much about. And so to get insight from someone who is literally on the ground doing deals and business in that realm, let's say, was absolutely fascinating.
Yeah, right.
And so you and I can sit here and see what happens in the NASDAQ 100 and the Composite and the S&P 500, but to then to see what's going on in private markets and to try and marry up, you know, who's right? Is the private market right? Is the public market right? Are they somewhere in between? I think it goes for like an hour or something, but I would listen to that. It's so far fascinating.
I will put that on the list. All right, so my review this week is a food review, and it's almost a bit of a cry for help, to be honest. So we had some donuts here the other day. We had Daniel's Donuts, and I'm gluten-free, and man, I swear to God, I would do almost anything to have a good gluten-free donut. Now, I'm told Daniel's Donuts are good. I don't know.
Daniel's Donuts are pretty good.
I don't know, man. I don't know. But the gluten-free ones, the icing was great.
Your donuts looked
They were sad.
stale.
They were. They absolutely, like, they've been out for a week.
They looked really dry and really stale.
Pretty shitty. So
I didn't eat one because I'm vegan.
I won't even go there. So my appeal is to the millions of listeners. If anyone's got a recommendation for really good gluten-free donuts,
all right, let's put it out there.
I'm bang up for trying them because they've all been pretty shitty, to be honest.
But I came into the office today, and so just for everyone listening, so the donuts come in like a tray, and there's like 8 of them in there.
No, there weren't 8, there were 6.
Okay, 6 or 8, something like that. Donuts.
They're really 6.
So I rock up at work this morning, and I have a look in the fridge, and there is one donut left. And I'm like, did you eat all those donuts? And you said you nibbled at them all day yesterday.
Kind of chipped away at them all day.
Chipped away,
a little bit here, a little bit there. The icing was good. That's all I'm saying.
Can't go wrong with icing.
So,
one thing I think we should start doing is just letting listeners and watchers know when we're recording this. So Thursday, the 3rd of March is when we're recording this in the afternoon. On that note, let's wrap up. Flick us a note.
Shoot us an email, people.
Jump on YouTube. Listen in on Spotify,
what's
Google.
the email address?
info@baharianwealth.com.au. And we'll be back next week. Thanks for joining.
Cheers, guys.